You buy a breakout, feeling confident. Seconds later, a violent downward spike hits your stop loss, closing your trade. You sit back and watch as the price rockets right back up into profit, without you. Institutions engineer these sudden crashes to hunt for the liquidity resting in retail stop-loss orders. This calculated fakeout is what the inner circle trader methodology calls a Judas Swing. This trap almost exclusively springs during the massive surge in global trading volume at the London Open, specifically inside the 8 to 9 a.m. window known as the kill zone. By decoding the mechanics of this maneuver, you can stop playing the victim and start positioning yourself alongside the market's true institutional intentions. Executing this strategy requires one mandatory prerequisite. You must establish your directional bias on a 4-hour or daily time frame before the London session even begins. Notice the flat consolidation channel marking the Asian range. At London Open, price brusts below the low, mimicking a genuine breakout. This drop triggers retail sell stops, providing volume to fill institutional buy orders. Price then violently whipsaws back up, leaving a long candlestick wick. The entire downward sequence was an engineered illusion, built to harvest liquidity before launching the true trend established on the higher time frame. A sharp drop alone looks like a market crash. We separate the two by tracking the recovery's speed and structure. In this upward reversal, price must rally and break above a recent swing high, a transition known as a market structure shift. Because this violent reversal is so fast, it leaves structural inefficiencies in the chart, primarily fair value gaps and order blocks. These empty zones mark the specific price levels where institutional buying was extremely heavy. It moved so fast that the market couldn't fill every order on the way up. Combining a market structure shift with a newly formed fair value gap confirms the fakeout is over and institutional momentum is locked in. Trading this setup requires strict psychological discipline. You must suppress the fear of missing out during the initial violent breakout and wait for structural confirmation to form. Wait for price to retrace into the highlighted fair value gap, triggering a buy limit order. Place a strict stop loss below the fakeout spike's lowest point. Target the Asian session high to secure a 1-to-2 risk-to-reward ratio. The Forex market is engineered to deceive the majority. But by mastering the Judas Swing and using FXNX's institutional-grade tools, you can anticipate the trap and secure a mathematical edge.